I always said that internet is kind of like entertaining place, but there are people like me are not coming online to entertain anybody. And what I am doing here is just to give you the idea, because I know our small business owners, you know what we are really lacking? We are really lacking about being nice to ourselves. Don't you agree? So you know, whatever you do, if there is a $1 and a need to go out and your employee are not getting paid, you would give that dollar to the employee. And you will be the last one ever got taken care of in general. So you are the business owner. That means you get paid the least, you get paid the last, and then you also are not getting paid at all when you think that the business is not running the way you are thinking. So it's just like, all right, and how do we draw that line, right? At what point of time, and we as a business owner would be motivated to continue doing good business, but getting ourselves pampered a little better, right? Of course, some of the business owners say that, Ying, it's not like I don't pay myself because I don't want to pay taxes. So I just gonna leave the money in the company and not to touch it. And if I really need it, I will get it. Otherwise, I don't want to pay taxes. Is that really how it works? Maybe not. So what I am doing today, I am telling you the general ways of how people paying themselves in general. Like as a business owner, we have more than 12,000 clients in our book, okay? So when we talk about general, I mean general, because we see a lot of cases, we meet a lot of people, we know how small business owner thinks. We are a one, so we're no different from you. And in some cases, just we are more experienced because we see how each one of you are doing. So we summarized 9 general ways like people can pay themselves as a business owner. Then I go to each entity type, like Schedule C, sole proprietorship, 1065, partnership, and S corporation, C corporation. So we talk about those general ones. Then we will go into each type of entity to just kind of articulate in this particular setting, if you are a C corp, and exactly how you would pay yourself. So I'm not making a judgment of whether you want to pay yourself more or less. I'm just giving you the idea of how the ways you can pay yourself. Then I will tell you which one is taxable, which one is not. So that would give you some general ideas. You can literally split up my webinars into the session that are relevant to you. Then you can, you know, tell your friend, hey, this is how you should pay yourself. Ways to get paid through your business. It is your business, folks. So of course, it's not always the more the better because it is your own business. So you always have a little worried about, you know, how much do I take? If I take too much, it's going to hurt my operation. And I know next month's going to be a slow month, so I don't want to pay myself so much, you know. So the way we paying ourselves, not only limited to just writing a check, is also impacted by how we understand our business. So a lot of times I want to say that when we reward ourselves for what we should pay, we need to be more like raise ourselves from the business, give a little distance so you can see your business like Ying sees your business. Then look at your balance, look at your overall health of the company, and then determine a good pay for yourself. I will tell you, it doesn't matter you work for other people or you work for yourself. If you just do not get paid what you deserve, the passion, the love of your business will diminish, will slowly diminish. Have you ever heard of people selling their business like really quickly? It's like they don't care. They just care about trashing it. They don't want it anymore. I hate this business. I don't want it. And you know how that emotions come about, then you no longer thinking logically. Your business may be worth a lot more money than what you are charging for, but why do you get there? And how did you get there? You got there because you are not rewarding yourself enough. If your customer is not here to reward you and writing you a love letter from time to time, you don't get the sense of what your customer is doing. You just see a number for sales. Then you yourself also don't reward yourself and giving yourself a pay and going back home, talk to your spouse, and he or she and the other person will be really happy and proud of you, knowing that you bring money home. If you don't have those kind of human interaction, human relationship, human reactions, then you slowly losing the passion for your business. You know how sometimes you will say something like, oh, I know this person really love what they're doing. They love what they're doing. Do you know what that means? That means they get 3 things regularly. That's why they love what they're doing. Number 1, they get recognition in the society. What they do get recognized. There's always people outside of organization encourage them to continue doing that. That's number 1. And number 2, the people who works in the organization has this positive vibe. So each other encouraging each other going forward. So that is another positive things in their life to make them feel like, oh yes, I'm doing the right thing. The third one is also one of the most important one, is getting paid. Imagine if I'm doing a CFO job and I'm getting paid like the position at Walmart cashier, and you think my CFO job would last? Of course not. Obviously, if I am a CFO, I am paid as a CFO. If I am a CEO, I am paid as a CEO. If I'm a partner, I am paid as a partner. So really, it is your job as a business owner to elevate your social status as well as your economic status into a position where it matches what you're doing. That is the way for you to stay on your job, stay in your business, and be always in love with what you're doing. It's very philosophical, but it is so important because we always sacrifice ourselves. In the very beginning of the business, you sacrifice yourself. That's very easy. That is encouraged. I remember when Community CPA just started back in 1998. I'll tell you, the first 10 years, I did not pay myself. And I did not pay myself. That doesn't mean like I'm all enthusiastic for 10 years and I was celebrating I didn't pay myself. No, I was trying to get paid. So I was having other full-time job. So that I got paid. So I only draw social impact and also the vibes that coming from the society, the community, the employees to keep me going, right? So that's important in the way to say that, yes, as a business owner, you can short yourself for a little while, but to run a real business successfully, you got to know how to pay yourself. So way to get paid through your own business is not something I'm doing it just because we're business owners, we want to do that. No, it is us making a contribution in your life to keep you going so you can be on that business for 5 more years, because just need another 5 more years, your business will become solid. To have a legendary, long-lasting business, then you need to start somewhere to get paid. So let's go forward what we are talking about today. And a disclaimer quickly about the content. Everybody has their own opinions. Even President Trump has his own opinions. So internet is internet, but when you make your special decisions on a special matters for your own business, remember, you can rely on free webinars like this to make that decision, making sure you contract, engage CPA firms, law firms, your friend, if they are capable to help you to have that opinion documented before you move forward, okay? Now, let's look at what I have here. Ways to get paid as a owner. You own a business and you sitting here goes, I want to get paid. And some people say, I want to get paid, but I don't want to pay taxes. Some people say, I want to get paid, but I don't have money to pay. So there's a lot of reasons for us to desire getting paid, but yet we didn't put out to pay ourselves, right? So now I want to just generally break that down for you, not to give you an answer because I don't know your specific situation, but at least you got your card in your pocket and pull one out, goes, should I do this? Should I do that? So you have a choice. So there's 9 general ways business owner can pay themselves. I'm just gonna go through these general ones. Then the next few slides I have, we will break them down into entity, okay? So now let's look at this. So W-2 salary, obvious, right? And if you made a good business, you will pay yourself salary because you work there, right? And you may say that, I don't want W-2, too much taxes. And listen to me, W-2 is also a vehicle to put away a lot more money for yourself. For example, 401k deferrals, that's $22,500 a year in 2023. If you have a W-2 and you pay yourself $22,500 a year, and you don't pay any income taxes because that whole amount can be deferred to 401k. So the only money you pay is Social Security Medicare. And your portion and your company will match the other portion. So roughly about 15%. But that is a Social Security Medicare. And you can't view Social Security Medicare as just tax. They're not. They are the social benefit when you come to older age. Or even more than that, if you happen to die early, your children, not 18 years old, do you know your Social Security benefit that you paid to the government would pay your children amount all the way till they're 18? It is a lot more than just old age security, folks. It is that social benefit the United States of America, the Congress put together for citizens, for people who are working in US to get some safety net. You can't be like, oh, I don't care about the safety net. I will be more than safe. No, life is so unpredictable. And even president of the United States might go to jail. That is how uncertain a situation can be. So don't take for granted and know that W-2 salary is one way to pay yourself, has a whole lot of benefit behind it, okay? 1099 payment. You can pay yourself, not W-2, you can pay yourself as a subcontractor, right? That's one way of paying yourself. But that one makes not much of a difference, folks, because once you got the payment, you bring it into your 1040 and you still have to pay Social Security Medicare. And it's like a W-2, only you take care of those payroll liability, payroll withholdings in one shot at the end of the year, right? But of course, 1099 payment also includes things that pay to yourself like interest. What if you loaned some money to your company and your company was using your money and agreed to pay you 10% of the interest, so you got paid? That's one way to get paid. Those interest payment, you don't pay Social Security Medicare. It is only for income tax that you will pay. All right. K1 distribution, that is also a pass-through entity where you pay yourself, right? And some people always struggle because they got a K1 from their S corporation and it's $100,000. So they brought that $100,000 into their 1040. They paid a lot of taxes. You know, income tax can be very expensive. And then they turn around and goes, Ying, this is just wrong. I didn't get any money from the company, but I'm just paying taxes on these number on the paper. And I don't have that in my bank account. So this is where your work with your tax preparer wasn't all the way home. And then normally those pass-through entity at the end of the year, you should distribute the money you pay taxes. So this is one thing that can be improved. Doesn't mean you don't have the money. It is probably just sitting in your company account and nobody touched it. I just had one client the day before yesterday, and it said that, oh, Ying, I have $100,000 in the bank account, in the company bank account. Can I take it out? And I said, why are you wondering? Why are you wondering about it? Why are you not taking it out? He goes, someone told me that if I take it out, I'll be audited. So it's just like, okay, maybe it is not a good idea to ask people who are not in this profession about a very detailed answer for a not very common situation. And when you have pass-through entity, those K1 distribution, whatever taxes you are paying, you are entitled to take that whole amount into your personal account. So part of it will pay taxes, then part of it will stay for you because it's distribution, right? And the 1099 dividend, that's in the C corporation situation. After the company paid taxes, the year is ending, the shareholder sitting around, and they will be getting dividend distribution if they want to. So that is another way to pay yourself to get dividend distribution. I'll talk a little bit more about that in later time, but let's go down the list. Loan from the company. If you're really just short of cash on your personal side, but you have this company has a lot of balance in the bank account, and that doesn't belong to you, let's say. You can loan money out of the company. You're the business owner, so you can make a note, borrow money from the company, use the cash for now. You don't report that as an income. You borrowed, but you need to know that you need to have a contract with your company. And sometimes you have interest. If you're just going to do a interest-free loan, nobody gonna against you. You're the boss, you decide, but you want to put that in the proper documentation. So if IRS walk in, goes, hey, you know, I saw you have $20,000 deposit in your bank account, and I think it is your income. You say it is loan from the company. Do you have papers? You goes, yes, here it is. I borrowed that day. I wrote this note, and that will be it. So it is proper, legal, no problem to loan money from your own company. Just make sure you pay it back. All right. And the reimbursement from the company. That's another big one. You know how sometimes when you just started a business, you know, this is a real example. We have a gentleman who does cleaning job, you know, around town. And he never had a company, so he was just doing that himself. So several years ago, and he was advised by his attorney that he should set up a company. So he set up a company. And the company set up, but he already did a cleaning job for several years. So he has some tools and things accumulated, right? So when he has the company, he really should be selling all the tools to the company or investing those tools in the company. So that money is his personal money that he already paid taxes for. Now he is just letting the company using the tools, and really the company should pay him back for that investment of the tools and everything, right? That is a reimbursement. So the company can write a check back to John, say that lawnmower, $50 paying you. So the company has an asset of lawnmower for $50, and you as a business owner and would get a $50 deposit in your personal account. That's a reimbursement. And what about you driving your personal car, running business, right? Then that mileage should be paid to you, shouldn't it? If you are an employee, you are doing that, the company would pay you a mileage, don't they? So same thing. So the business should reimburse you. So there's a lot of things that might need to be reimbursed. So that money you got from your business is no tax to you. That is tax-free. company paid benefit. If you're running a successful business and you're going to buy health insurance for yourself, and you're also going to have your other employees join in, you got a group health insurance. And that is paying you, but it is not your income. So the company will pay and deduct, right? Same thing. If the company is going to buy a vehicle, company buy a vehicle and allow people who making sales to drive the vehicle around. And yeah, you're the only one doing the sales. So you're the one driving the vehicles all the time. You're driving company's vehicle. So everything is paid by the company. You don't need to pay anything unless you take the company vehicle, went into Toronto, Canada to visit my mom there. And then, maybe that's your personal enjoyment and you should reimburse the company back for using the car, right? So these are the things. A company paid benefit is out of company expense, but it's not a taxable income for you. And you can also pay back, you can also get the payback for the loan you loaned to the company. So the company can write you a check goes paying you back $5,000 that you put in at this time. So that is the money come back to you and you don't pay taxes. And it may be in the very beginning of the company, you put in $100,000 as a investment, and later on company has a lot more money in the bank account. You want to pay yourself back, capital draw. That is, as long as you are drawing the same amount you put in, there's no capital gain for it. So it's non-taxable. Okay, vendor payment. What is vendor payment? So let me explain. When you have a business, maybe you have two. One business is a restaurant. The other business is a snow plowing maintenance company, for example. The restaurant paying vendor payment to your other company for plowing the snow. So service. So you actually can arrange those vendor relationship, right? For example, you bought a building and you put your restaurant in there. Your restaurant is paying the building rent. That rent has so much room for you to decide how much would that be. Of course, IRS would always tell you that, well, you need to make it arm's length. It didn't need to be reasonable. But rent from $5 square footage to $45 square footage, there's all over the place. And what is reasonable? The range is huge. So if the vendor payment is both on your company, obviously you can decide for this year, my restaurant is really not doing that great. I can't afford to pay rent. So let me do rent on $5 per square footage for this year and the next year. Then we'll talk about it on the third year. Third year come around, restaurant become really good. Then you re-sign the lease. I'm paying you $25 per square footage. Then the money will go to your other entity with a bigger volume, right? So this is what I call the vendor payment. Vendor payment is a very big tool in terms of working your inner circles, like your friends and you, your family. And President Trump did a lot of that, okay? And I don't really know all the cases in the details, but I have not seen one challenge related to vendor payment. But he make payment from one company to another. That's a daily soup for him. So, just to say that it is a regular business activity and the people do that. Okay. So much about general 9 ways, right? So now we go into each type of entity. So what type of entity do we normally see as a small businesses? We normally see Schedule C, which is the single member LLC as well, right? And we see partnership, like multiple members partnership, S corporation and C corporation. So in the Schedule C, know that Schedule C, sole proprietorship, single member LLC, and you normally, when you are in that way, you normally is a small business. When you are small in that way, and you're not even sure whether you're going forward with the business or not. You haven't really incorporating that yet. You're just trying it out. That's okay. And I would still encourage you to have a separate bank account for that Schedule C. So let's say you have your artist, you're doing freelance art assignment, and you have a Schedule C. And in this case, and whoever client pays me, I put that in a separate account. And if I buy materials, I use that account to write down. So at the end of the year, I had $5,000 left inside of that bank. So what I say here is, whatever you have left in your bank is what you can take. And don't be concerned of tomorrow. If you are a small business on Schedule C, you go with your bank. So whatever your bank left, you take it. But of course, if you say, well, I just bought something that the check hasn't cashed yet, so my 5,000 really gonna be just 2,000. Then you need to know that. You need to know what's still not cashed out yet. So the net balance you have, it is what you can take. So when you take that, doesn't mean that you're gonna be paying taxes on that. In Schedule C, remember, you can even book other expenses, right? Other than material, and this artist can book home office. So they would come in to reduce the 2,000 net profit. So in the end, you probably don't pay anything, but from rewarding yourself, you can take that 2,000 all to yourself. And you are not paying taxes because your home office deduction was 2,000. So you really didn't make any money on the book, but you actually have a 2,000 sitting in your business account because that 2,000 is to reimburse your home office. Does that make sense? Right? So now let's look at what other ways you can do to pay yourself. In Schedule C, if your business is running bigger, you can pay yourself on W-2, even though it is not needed, but you can, because once you have W-2, remember, you start having other benefit related to as an employee. And now, of course, you can pay yourself 1099, and it is again not necessary because whatever in the Schedule C schedule, the leftover is going to be taxed like your income. So, you don't have to, but you can. And if you loan the money to your sole proprietorship and you think that you need to get paid for the interest, that's your 1099 again, right? And you, of course, should book all the reimbursement that should be going back to you. Your mileage, your meals, and your home office. And, even maybe you file taxes with Community CPA, we charge you the money, and you wrote your personal account to us, but actually, at least half of that fee should belongs to the business. Then you have business reimburse you. So that's reimbursement and company paid benefit. When you are running on Schedule C, you can do solo 401k. That is on that Schedule C, you would be able to put in your self-deferral amount, $22,500 as a deduction. So those are company paid benefit, and which it is going to go to your account, but you don't pay taxes and you paid yourself, right? Vendor payment, if you have another business that this sole proprietorship business need to pay money to that one, there you go, it's your expense, but you actually paid yourself to another business. So this is how sole proprietorship works. Let's look at a partnership. 1065. Take money out of partnership. I actually wrote about that in my 8 a.m. book. And it is an example about Joe and Francis. So this is an example I put out there to explain how to how to take money from the partnership by each partner. There is 5 regular ways to take money out from partnership. Number 1 is salary, okay? And number 2 is guaranteed payment. So what is guaranteed payment? Normally, like in the example I have at 8 a.m., Joe and he has money and Francis don't have money, but 2 of them partner together to do house flipping work, right? So with that said, and you know how Francis would be working, and Joe just give the money, that's it. So Joe said that we will make sure we pay you through the guaranteed payment, which means that it's basically reimbursing, basically pay Francis the labor job that he did, right? So that guaranteed payment is also like a 1099 NEC to Francis. So it has become partnership expenses, but particularly going to one person. So if you are one of the partners and you know you sweat more than the other partner, so maybe the recommendation is that, can I get a guaranteed payment for the labor I put in, right? Then after you deduct this labor, whatever left over, you split by percentage. So that way is fair. Otherwise, you don't have this guaranteed payment and you're just gonna split, you know, the one who works most will start having some complaints, right? Capital draw. So normally when as a partner, we all put in the capital to run this business, right? So in Joe and Francis's example, and you know, Joe put in $250,000 to buy the property so Francis can flip it, can work on it. But let's say in the middle of the working, and Joe said that, hey, I noticed that you didn't spend all of the $250,000. There's $100,000 still in the bank account. I'll just get that drawn back because we don't need it. So that's a capital draw, as long as you did not overdraw it. And it is just money refund back to you. So it is like getting money back, you know, and no taxes on that because you didn't over withdraw, right? And the reimbursement is a really interesting one in partnership. And when you are in partnership, if you want to do reimbursement, there's 2 ways to do it. One way is to do it inside of the partnership. The other way is to do it on your 1040 individually. A good example would be Emily in my book on 8 a.m. What happened is Emily partnered with another lady to do this job agency. But Emily has a huge home. So her home office expense was like $6,000 a year. But the other lady is just younger and less established, and he rents apartment. The apartment is only like $2,000 a month. So if she count, 25% of that to be a rental, it is just not much. So for that reason, if they reimburse home office at the partnership level, it would be not fair because part of the deduction that Emily has would become a benefit for the other lady because she did not bring the same amount of expense. So in this case, reimbursement would happen at the personal level. So we will say that, hey, our partnership is not going to reimburse this one. Emily, you go to your 1040 to do that deduction. And I forgot the other lady's name, and she'll go to the other, her own 1040 to do that. So with that, and they can get reimbursement and out of their 1040 filing. But this reimbursement is not taxable, which means that they will get it back for free, okay? And whether it is at the partnership level or at the individual level, they all get it for free, no tax. The only difference is if it is at the partnership level, it is treating the expenses as a whole. So even though Emily has more expenses, but she's not going to get more deduction because it's split by the percentage, right? All right. Then the number 5 for partnership to get paid is distribution. So-called distribution is the end of the year. You do the financial statement, you got your net profit or net loss. Doesn't matter, whatever that is. Then you have your share, you have your K1, the other person have the other K1. So you take the K1 to the 1040. That K1, if it is a positive number, and normally when you close out the year, we tell the partner that they can take that money home, which means that we can write a company check, pay to the personal, and this writing a check, pay to the personal, and that should be done every year. And you already paying taxes on the K1, so you don't need to pay tax again. So you just do the K1 and get distribution, all right? Apologize for my voice. So with the partnership, there's also other ways, not so common. The common ones we talked about, this 5. The other 4 are not common, but can still be done. 1099, that is related to pay as an NEC or pay as an interest. So payment from the partnership to you, that is normally taxable. Loan from company, of course you can borrow money from the company, and that is not taxable because you're supposedly to pay it back later, right? And company paid benefit, normally not taxable because company take care of it, and you may be the key employee for the company. See, I'm talking about W-2 benefit again. If you have a W-2, you are an employee, and you can be a key employee. The company can buy a life insurance for you and pay for the premium. So you have the benefit, but the company is taking care of the premium. Of course, there's more things need to talk about when we are talking about life insurance, and we can definitely go into detail to show you how to structure that, how to structure benefit, and that would need you to get on my website and engage me for that time. And then I can show you exactly how company paid benefit can benefit you. Of course, vendor payment. Vendor payment is huge. You maybe have 5 different partnerships. Maybe one partnership is a rental property. The other partnership is the operation. Then the operation paying for the property that they're using. So these vendor payment, when they become inner circle, when they become related company, these vendor payment has a lot of room to make it legit, but also beneficial. So that is, when you get into IRS audit, and if you ever needing to go through intercompany transaction analysis, a lot of times the market value will come into play. IRS will say that, okay, is this a payment reasonable with the market? As long as you can prove to be reasonable. For example, we had an audit long time ago. It's about vehicle transfer. And the vehicle is a company vehicle, then got transferred to the shareholder as a personal vehicle. So when you do that, it's like a company selling that vehicle to the business owner, right? So what price do you sell that for? And in that particular audit, what we have done is when we sold it, we used the Kelly's Blue Book to find the relevant car model, the year and the condition. So we use that value to sell that vehicle to the shareholder. And once we prove that with our documentation, IRS don't have any problem. They understand where you got that benchmark. So the market price is a work that you need to do. But as long as you're within this general scale and not selling your car for $1, and then you should definitely be okay with that transaction. So that's what I'm trying to mention to you. And 1120S, generally 2 ways to pay shareholders. W-2. W-2 is a key in S corporation. And if you're a shareholder, you're working in S corporation, you are the shareholder employee, and you are subject to reasonable pay scrutiny because IRS want everybody to pay Social Security, Medicare. So when we are older, we're not going to become the refugee kind of status. We have our own Social Security benefit, can live a reasonable life. That's really a society protection, right? This is why we call United States of America a great country because we have a great benefit. Social Security, Medicare is a core element for that overall benefit. Other than we can vote, that is also a huge benefit. So going to talk about these two, the other one is a K-1 distribution. So that K-1 distribution we got from 1120S, that one you don't pay Social Security, Medicare. That is one of the reasons why W-2 is extremely important. The IRS knows that if you pay W-2, you pay Social Security, Medicare. If you get a K-1 distribution from 1120S and you don't. So these are the most common ways for S corporation to send money to you. But there is other ways. 1099 payment, we sort of cover that, and you know that 1099 just means the company gonna write a check to you and issue a 1099, and you take this 1099 to your 1040, you need to pay taxes or whatsoever, right? Loan from company, you absolutely can borrow money from the company, deposit that into your personal bank account, spend it, but don't pay taxes because you should be paying it back, right? Reimbursement from company, of course, is tax-free because you spend money for business things. Now business refund you, reimburse you, legitimate, no taxes to be talked about. And you just write yourself a check, reimbursement, deposit in your personal bank account, you're good. Company paid benefit, same thing. Company paid benefit stays in the company, even though it is your benefit. Until you claim it, there should never be a tax for you. And pay back the loan to the company. You may be a shareholder that already did a lot of loan to the company because the company keep on losing money every year. And then slowly the company start making money and you still have the loan amount that company owe you, write that back to you, okay? And then that should not be taxable at all. It is the money you give and you come back. It's a loan to company and it should come back to you, as it is. So no tax to talk about. Capital draw on 1120S. So you have a base, we call that base. It's just almost like when you come into 1120S and how full your cup was. So as long as you're not overdrawing what's in the cup, and you should be okay. If you draw more water than what's in the cup, then you need to pay capital gain. Sometimes we see clients paying capital gain on their taxes. They didn't even realize. And they come to us and we look at the taxes, goes, well, last year you overdrew nearly $500,000. You paid about $100,000 on capital gain. Did you know that? Oh, no, they don't know. They didn't even know why they paid so much taxes. They just thought they made too much money, but didn't understand that is not related to the money they made, is related to their overdraw their capital account. So be mindful, and you don't want to trigger a tax result when you working with your capital, okay? And vendor payment is another one. You may have several S corporation, or you may have a C corporation. So whatever company you have, between the companies, the business transactions is allowed. And you can work your business to see how that is most beneficial for you. So vendor payment is a huge tool for intercompany and related company. All right, C Corp. C Corporation 1120S. To get money out of C Corp, two normal ways, W-2 and a dividend. See, not a distribution. I wrote dividend. Dividend is to distribute the after-tax profit the company had, and it's not required. For small businesses under my care, you don't need to worry about this dividend. You don't have to. You can leave the money in the C Corp and let it grow inside, maybe buy a huge property in the future under the C Corp. So there's no need to do dividend distribution and pay tax. But if you do, yes, you pay tax. Let me show you how much you pay taxes. And before I go to explain to you how much you pay taxes, let's just look at what other ways you have. You have a 1099 payment ways, you have a loan from company ways, okay? That is huge too. You know, your C Corp might just have a lot of money in there and you did not take dividends, and you can borrow them out as long as you have a proper way of borrowing it and paying it back, and you're good. You don't have to pay taxes on that loan you got. Reimbursement from company, don't forget that. That is tax-free. Company paid benefit, huge. In C corporation, absolutely. So if you have a C corporation and you don't know anything about company paid benefit, you need to come to Community CPA to talk about that, okay? And you can, company borrowed your money, paying you back, or you put in too much money and you want the capital to go back to you, those are money to come back to you. And the vendor payment again. So very quickly, I want you to understand the dividend, because dividend is not distribution. Under C Corp, the dividend is the amount that goes to you, goes to shareholder, and that amount is after tax profit. So, but the rate for dividend tax is very low. So it is not like an income tax. So if people with, people without social security number, maybe you have IT number and you don't really do W-2 because you can't. The W-2 would withhold social security, Medicare. You have IT, you cannot do that. In that case, if you have a C Corp, you would run dividend payment to yourself. So even though you got $50,000 on dividend, but you don't pay nearly as much as taxes like $50,000 on W-2. So it is really a low income tax type of income, allow the IT folks to get paid regularly, but they're getting paid on dividend and also live an ordinary life, right? So you don't have to go under table payment, you can live your life properly. In my 8 a.m. book, in that appointment with Ying at 8 a.m. book, and there is a guy called Jose Hernandez, and Jose Hernandez is a avatar, is a personality I made up. The name is made up, but it's actually a real story. So how he used IT number to make one of the most successful business I know in that area. So it is a tremendous technical know-how in that story. So if you're an IT person, you felt like you couldn't really, you have to do under table deals, you can't make your work known, you can't make more money, you are so wrong, and you should read that book or go onto Amazon to buy audio version. I have English and Spanish version on Amazon for that book, so you can follow Jose Hernandez. So the last slide I have here is just to show you the 1099 dividend. You see how that is looked like that? And that's a 1099 dividend that you would use. All right, I think I am running out of time and we are almost over an hour. And this is our contact information, folks. Email Catherine at communitycpa.com, and you can call our office. We open 6 days a week. Do you know that? I should put out a quiz to the internet to have them guess that whether there's any CPA firm in United States of America open 6 days a week, year round. The answer is no. There's only one. That's communitycpa.com. So we open 6 days a week regularly. So if you just never have time during the week because you're busy, Saturday, we're always open. You can call us and we will take care of you. And I hope this talk is organized in such a way that you can zoom into your situation and figure out how to pay yourself. Folks, let me give you the last piece of advice. It doesn't matter how successful you are or how not successful you are. As long as you are a small business owner, trust me, your job is to figure out how to pay yourself. Until you did that, and you will be successful, people around you will prosper. Because if you don't take care of yourself, there is no way your business is gonna last. So don't try to be not selfish in that particular regard. And I love selfless people. And I will tell you that I am a selfless person. And I love people who are selfless, always watching for others. But I also want you to know that coming down to an economic impact on a mind, and as a business owner, we cannot ignore ourselves. You need to figure out a way to pay yourself. If you don't have money to pay W-2, you will reimburse yourself. If you don't have money to reimburse yourself, you will figure out how to get yourself into other ways, maybe borrow money, or maybe doing something, but still take money home to make your other party happy, to make your life outside of business okay before you can become more successful in your own business. Makes sense, right? I know you agree with me. It is easier said than done, but as long as we have that in our mind, and we hope that to follow that, that calling, and knowing that I need to take care of myself, get paid so I can do better. I got one question from you. Are bonus payment taxed less than regular payment? The bonus payment is taxed exactly like W-2. So if you're saying that let's not pay W-2, I pay myself bonus, no. It is the same thing. So, as a business owner, don't pay yourself bonus. To have the business going forward is our bonus, but making sure that you pay your W-2, because that W-2 not only give you a legitimate W-2, so you can get loans or buying your houses, things easy. And also that W-2 entitle you to be an employee. As soon as you are an employee, you may be able to purchase key employee life insurance. You may be able to get health insurance all paid by the company. And you may be able to use the company car because that's an employee used car. So you need to entitle yourself into an employee status to enjoy a lot of benefit that's put out by the government. Otherwise, as a business owner, if you're not employee, you're just holding an ownership of the company, you're not getting much unless company is making a lot of money, you get distribution, right? Or dividend. All right. And thank you very much for joining me today. And I hope to see you again on Tuesday, 3 p.m., Saturday, 3 p.m. is my time with you. And I will be talking to you with all the important questions that you ask. Bye-bye.